Hello everyone and welcome to this session where we would be discussing about the chapter on reconstruction of companies, also sometimes called as internal reconstruction, a fairly scoring chapter and from your exam perspective, something which has a fairly high probability of coming up in your exams. So when we look at reconstruction of companies, what do you mean by reconstruction and how different is it from, let us say, an amalgamation, absorption or a holding subsidiary acquisition? First of all, when you are looking at an amalgamation or an absorption, there is a company, let's say like Air India, who is acquiring another company. Let us say, for example, hypothetically Vistara. And here Vistara is merging, for example, with Air India, in which case we say that there is an absorption, which is, let us say, happening. Or let us say there is a company like Flipkart, which is acquiring a company like Myntra, in which case they are going to operate as a holding subsidiary relationship, in which case a consolidation happens. However, when we look at an internal reconstruction, I'm doing a deep introspection of my own self. I'm not going and acquiring someone else. I'm not joining my business with someone else. No, I'm just cleaning up my own business. So over here, what happens is most of these companies which go for an internal reconstruction have balance sheets which are a little battered and bruised balance sheets. Like when I say these are balance sheets where there is a lot of liability, the relatively lesser assets, and there is huge accumulated losses. So what happens at a lot of places over here is we say that, well, if I have a huge loss, lenders will not give me more loans to revive my company. Creditors will not give me credit, and hence I'm kind of in a dilemma where I want to come out and I want to turn around. However, I will not receive the support of external parties because of my position, which is quite poor, and hence I will go with a scheme of reconstruction or reorganization. I will approach the court. I will meet my lenders, I'll meet my creditors, I'll meet my shareholders, tell them to let go of something, and so that we can write off these balances. The idea of this scheme entirely is to clean up my balance sheet, and if I want to clean up my balance sheet, there are huge losses or fictitious assets or miscellaneous expenses which have debit balances. You want to remove it, so you want to credit it, but then something has to be debited. So we are trying to arrange for resources by people foregoing, let's say, loans. Lenders forego some of their loans. Trade payables, some forego something. In a similar way, shareholders who have shares of 10 rupees will say, okay, I will reduce my shares to 2 rupees. So everyone will kind of pitch in, and thereby I will generate enough, let us say, bandwidth to write off my losses and clean up my balance sheet. But this is a scheme which needs approval, because you don't want reduction of share capital, and passing of this scheme is a very special transaction, and hence under section 66 of the Companies Act, you will need to approach the court, seek the necessary approvals, pass necessary resolution, and if the court approves that scheme, then as a part of that unique special scheme, you will try to restructure or reorganize your company's balance sheet, clean up your accumulated losses, fictitious expenses, and you will reduce your liabilities or share capital as has been agreed. Now all of this is routed through a special account which is usually called as a capital reduction account. Sometimes this is also called as a reconstruction account. Like you use a realization account in case of closing of a company, you use a capital reduction account, and sometimes if it is specifically asked, we can even rename it as a reconstruction account. It is one and the same. Now because all of these transactions that we are just going to discuss are happening as a part of this scheme, everything will go through the capital reduction account. Like usually, if lenders worth 100 rupees agree to forego 50% of the amount payable to them, which means 50 rupees is foregone, I will pass entry loan account debit to. Usually I will say that's a gain for me, which will go to the P&L. No, I will credit it to the capital reduction account. Or for example, there are trade payables who are agreeing to forego 20% of the amount due to them. Let's say 500 was due to them, 20% of that is 100. Your entry will be trade payables account debit to what? Capital reduction account. Perfect. Now apart from lenders, creditors pitching in, you will go to the owners, the shareholders, and say that, well, you know what, you have 1,000 shares of rupees 10 each. We need to kind of need more resources. So shareholder says that, okay, I will reduce my face value as well as paid up value from 10 rupees to, let us say, 2 rupees. So thereby I will get lesser dividends, etc. in the future because my share value is now relatively lower. In which case I will pass the entry equity share capital account debit. Usually one would say that, well, if the share capital is going from 10 rupees down to 2 rupees, that's a reduction of 8 rupees. So equity share capital ideally should have been debited by 8 rupees. However, what happens is in case of shares, they come with a face value of 10 rupees. Now I need to cancel those shares of 10 rupees and issue new shares worth 2 rupees. And hence my entry over here will be equity share capital account debit. For example, 8 into, let us say 1000 shares are there, that is 8000, to equity share capital account debit. Over here, net I have to debit 8,000. However, these are shares of rupees 10 each. So I'll first cancel those entire shares. Equity share capital account debit of rupees 10 each. Account debit 10,000. To equity share capital, new shares will be issued of 2 rupees each. 2 into 1,000, that is 2,000, and the balancing figure 8,000 will go to the capital reduction account. We'll discuss these entries. However, even then you might fall short, so you might kind of realign your assets. Maybe your building, which was worth 500, is now worth 600, so your building is to be increased. So usually building account debit by 100, the credit should ideally go to the revaluation, but because it is happening as a part of a capital reduction scheme, the credit over here will still go to the capital reduction account. Now sometimes the building will increase, but there might be other assets like plant, inventory, debtors, where the values might go down, in which case you will say capital reduction account debit to, let us say, these respective assets which are reducing in value. All said and done, at the end, there will be accumulated losses, and that is a hidden adjustment. Even if the question remains silent, you will write off the accumulated losses. So your entry will be capital reduction account debit to P&L, to preliminary expenses, to discount on issue of debentures. You will write it off, and that is the objective of the capital reduction scheme. Now, apart from that, there may be a few other special adjustments as well, like there might be certain contingent liabilities which have just been disclosed, like arrears of dividend or some pending lawsuit, and they need to be settled. So ideally, when they need to be settled, the entry is payable account debit to bank. However, if you have not recorded a payable, then how can you debit the payables? And hence, if contingent liabilities which were earlier just disclosed are now settled, the entry will be something account debit to bank. Well, because the settlement is happening as a part of a reconstruction scheme, you will say capital reduction account debit to bank. Or it is possible that these contingent liabilities which were earlier merely disclosed are now waived off, in which case, well, usually when you waive off something, the entry is liability account debit to capital reduction. However, because you are having something where you have not recorded the liability in the first place, then at the time of waiver, you cannot even reverse it. So your entry will be not there, double entry. For you to waive off something, well, a credit balance has to be debited, but if there is no balance, there is no question of debiting or crediting, and hence for contingent liabilities which were merely disclosed being waived off, there will be no entry. Okay, so after doing all of this process, your capital reduction account might have some balance. Now, usually the balance will be appearing on the debit side, that is to something. Well, usually this will be taken to the capital reserve. Why? Because capital reduction scheme is a very special scheme. It is not happening in the day-to-day course of your business. It is not like an amalgamation or absorption. Remember, that is covered by AS 14. For internal reco, there is no accounting standard. But the balancing figure is arising out of a special transaction that is special, and hence we will take it to the capital reserve. So these are the usual things, the typical questions that will come over here. We'll ask you to pass journal entries, then sometimes even ask you to prepare capital reduction account as a part of your fair workings, and then ask you to prepare the balance sheet. While you are preparing a balance sheet after reorganization, remember, as per Companies Act, you have to give the name of the company. Let's say Revise Limited is the name of the company. After internal reconstruction scheme, for a period of 5 years, you have to say Revise Limited and reduce. The word and reduce has to be added so that people know that this is a company which has come out of a reconstruction scheme. So when you prepare an internal reco balance sheet, be mindful that you write the name of the company, XYZ Limited and reduced, and you prepare the balance sheet. So typical format that we will use is, if a journal is asked, which is vast majority of the questions, I think almost all questions will have a journal. We'll prepare the journal, write the narrations as well in short, and also prepare a working note for capital reduction account. So usually 1.5 to 2 sides, you'll prepare the journal. Then for around 1/3 of a side, you'll prepare the capital reduction account, and then you will prepare the balance sheet as well. While preparing the balance sheet, you will prepare the entire Schedule 3 format of the balance sheet blank, and then notes to accounts. May you write down note 1 share capital, where there will be changes. So what will happen is, as and when you read the sum, you will keep on passing the entry for each of the adjustments. Simultaneously give one effect in the capital reduction account if applicable, and the second effect in the balance sheet, because if you wait for giving one effect now, one effect later, there is almost certain that you will forget something or the other. Apart from the regular sums of internal reconstruction, a couple of special cases will also be there, which will involve subdivision of shares or share consolidation, or conversion of shares into stock or stock into shares, and share surrender. So first we'll take the big bulk of internal reconstruction, complete that off, and then you go to the share surrender, share conversion, etc. So over here, what happens is, let us say when you look at an internal reconstruction scheme, remember this is governed by section 66 of the Companies Act and needs approval by the court and also special resolution. Next, when you look at, for example, the accounting over here, In case of internal reconstruction, you will prepare a special account, as we said, called as capital reduction account, which is sometimes even called as a reconstruction account. The sample journal entries over here is if you are revaluing the asset, it is asset account debit to cap reduction, not to revaluation. If there's an increase, if there's a decrease, cap reduction account debit to the asset, not P&L over here. Second is a waiver of liability. If there's a waiver, liability is debited, liability account debit to what? Sir, capital reduction. So over here, liability account debit to capital reduction. And third is writing off losses or fictitious assets, which is the core objective of the scheme. Some questions remain silent. They don't say that the loss has to be written off. We will still write it off because that is the core objective of the scheme. That is capital reduction account debit to P&L debit balance to fictitious assets. Fictitious assets can be over here, items like preliminary expenses, share issue expenses, underwriting commission, which are not yet written off. Next, you have the entries for reduction of share capital. Usually, when the share capital is reduced, you will reduce the face value and paid up value both. Almost every sum that is there in your material has a reduction of face value and paid up value both. If nothing is given, it is assumed that you are reducing face value and paid up value both. That is, shares of rupees 10 are cancelled and new shares of rupees 2 are issued. However, rarely, rarest of rare cases, there can also be a case where there is only a reduction of paid up value, in which is the share of 8, share of 10 continues to remain a share of 10 and it becomes a partly paid share of 2 rupees, but that will not be done unless the question specifically tells you so. So in case of reduction of share capital, if there's a reduction of face value and paid up value both, which is the case, you'll say equity share capital of rupees 10 each, to equity share capital, let's say new shares of 5 rupees each, to capital reduction. So this is a more common thing. Then if nothing is mentioned, we'll assume that there is a reduction of both face value and paid up value. Now, in case there is a balancing figure, it should be transferred to the capital reserve. So if there's a balancing figure in the capital reduction account, you will transfer it to the capital reserve. Usually, the balancing figure, when you prepare the ledger, will come on the debit side. So capital reduction account debit to capital reserve. However, rarely, it will also come on the debit side, in which case the institute will give you guidance, like you will have to use some reserves or something. Don't take goodwill over here. Remember, goodwill arises if you were to acquire someone else's business. Here you are reconstructing your own business and hence goodwill will not arise. The question will usually give you guidance, and if no guidance is given, we'll continue to remain that in the P&L balance. We'll say to that extent your P&L balance cannot be written off. So over here, this is regarding the balances if they arise in the course of capital reduction. Now, if there are any unrecorded liabilities like arrears of preference dividend, which is very common, which is either waived off or paid off. As we said, if you are waiving them off, there will be no entry. So there will be no entry since there is no liability. So if you are waiving it off, you don't have to reverse anything. But if you are paying off something account debit to bank, so you will debit capital reduction account debit to bank. In fact, sometimes there can also be expenses which are linked to capital reduction scheme. And if there are expenses which are linked to a capital reduction scheme, then those expenses also something account debit to bank, you will take it to capital reduction account only. So basically everything that is arising as a part and parcel of the capital reduction scheme will be routed through the capital reduction account only. Now that is the core of this standard. Apart from that, there are a couple of other special cases, like what if there is a share subdivision or a share consolidation. In case of a share subdivision, what happens is if your company has 1000 shares of rupees 10 each, it will now become 10,000 shares of rupees 1 each, for example, in which case you are not foregoing anything. It is just that there is a one big 1 kg cake, you are now splitting that into 2 half kg cakes. In a similar way, there was 1 share of 10 rupees, now it is becoming 10 shares of 1 rupee each, in which case your journal entry will simply be equity share capital into bracket rupees 10 account debit. Let's say that is 1000 into 10, that is 10,000, to equity share capital into bracket rupees 1, that is 10,000 into 1, that is 10,000. There will be no capital reduction involved over here. This is a share split. On the other hand, there's a share consolidation where 10 shares of 10 rupees become 1 share of 100 rupees, in which case you'll have equity share capital into bracket rupees 10 account debit, let's say 10,000, to new equity share capital of rupees 100, that is 1000 into 100 or 100 into 100, whatever it is. And that will go to the share capital. So your entries over here is share capital account debit to share capital. That is it. In case of a subdivision or a share consolidation, usually a share subdivision is done and is actually similar to bonus, but for bonus you need reserves. If a company like Swiggy or Zomato wants to subdivide its shares, wants to increase the number of shares, but it does not have reserves because it is a loss-making company, then they will use the subdivision route. If they have reserves, they can use the bonus route as well. And share consolidation is usually done in case your shares price is very low and you want to show a higher price so that your share is in the investor's radar. Otherwise, 1 2 rupee share no one will look at, and hence you will do share consolidation. This is just a practical application. Another thing which the institute can ask you a question is conversion of shares into stock. What is stock? Well, shares cannot be bought and sold in decimal. However, if we say that forget the number of shares, like if you look at Bitcoins, if you are aware, can be bought and sold even in decimal points. So over here, we are trying to say that we don't want to restrict ourselves to the whole number only. We want to buy or sell lump sum, whatever value. Then you can, instead of shares, have a stock. Usually stock is not as popular in India. Almost every company that you will be aware of has shares only. But in the exam, if a conversion comes, you cannot say that practically this is less. So in case of conversion of shares to stock, your journal entry will just be equity share capital account debit. Let's say if your share capital is 10,000, equity share capital account debit 10,000 to equity stock 10,000. Remember, you can convert shares to stock only if they are fully paid. Subdivision can even happen for a partly paid up shares, but conversion to stock can only happen if the shares are fully paid. So unless given otherwise, you will assume that if the conversion from shares to stock is happening, it is shares are fully paid. And secondly, if there is a reconversion, later you say that I don't want the stock, I want shares, then equity stock account debit to equity share capital, that's about it. So there is first two questions in your study material pertaining to this conversion, reconversion. It has also come once in the exam, but largely your questions will pertain to usual capital reduction scheme. Now a very special case, the last special case over here would be something called a share surrender. Now in your foundation and your early inter, you might have also seen share forfeiture. What is share forfeiture? Share forfeiture is if the shares are partly paid and a call is made and you are unable to pay after reminders as well, then the company cancels, that is forfeits your shares, and if required, the company can even reissue that shares. Share surrender is similar. However, in case of a share surrender, instead of a forced cancellation, there is voluntary. Like a company has 10,000 shareholders, promoter is holding 6,000 shares. Promoter says that I will surrender 3,000 of my shares to the company, and the company can use those shares to pay off its liabilities. So it is a voluntary donation kind of a thing to the company, and hence in case of a share surrender, your entry will be equity share capital account debit to share surrender. When the shares are being surrendered, we'll do sums on that as well. Now these shares which are surrendered can be used for paying off liabilities. Like it can be used for paying off debentures, it can be used for paying off creditors, etc. In which case your journal entry will be like you are issuing new shares out of the shares surrendered. So your journal entry will be debentures account debit, trade payables account debit to share surrender. So this is out of the balance 3,000 shares that have been surrendered. So your share surrender was credited, now it will be debited over here. So you will have, when the shares were actually being surrendered, your entry will be equity share capital account debit to share surrender, and when these debentures are being paid off, you will issue them shares, and hence the debentures will be debited. Trade payables will be debited. The company is not directly paying anything, it is paying out of the money which is received from the shareholders. So you will be debentures account debit, creditors account debit, that is a gain for us, so to capital reduction, and then share surrender account debit to equity share capital. Institute prefers passing two entries, so you will do that. First, when the liabilities are settled, debentures account debit, trade payables account debit to capital reduction, because that is a gain for us, because we are not paying anything, it is out of the 3,000 shares that is received, it is as if the creditor is directly being paid off by the shareholder. And secondly, the money that we had or the shares that we had, we are given those shares. So this is share surrender account debit to equity share capital. Now what will happen is, after doing these reissues, there is a possibility that there may be some balance which is remaining in the share surrender account. Like there may be balance in the share forfeiture account, which was usually taken to the capital reserve. Here, because it is arising as a part of the capital reduction scheme, the balance, if any, will be taken to the capital reduction account, but ultimately the balance in the capital reduction account in any case goes to the capital reserve only. So we will also discuss regarding share surrender in our sums, but this is your brief theory and a overall understanding for the steps for your internal reconstruction. If you are clear with this, handling the sums becomes a lot more easier. So let us review the questions over here. Let us say if you look at internal reconstruction, in the first question you will have a subdivision. Second question is pertaining to a conversion of stock into shares and vice versa. So these are all reorganizations that you are doing. Okay, let us review. On 31st December 2011, B had 20,000 10 rupee equity shares as authorized capital, and the shares were all issued of rupees 8 paid up. Again, on 31st December, B had 20,000 shares of rupees 10 each as authorized capital, and the shares were all issued, of which 8 was paid up. So it was partly paid up shares. In June of 2012, the company in the general meeting decided to subdivide each of the shares into 2 shares of rupees 5, which rupees 4 paid up. So in June 2012, your entry will be equity share capital account debit. These are shares of rupees 10 each, account debit, to equity share capital. These will become shares of rupees 5 each. Yes, the amount which is paid up is only 4 rupees. So this will be, what you are debiting will be 20,000 shares of rupees 8 each. In your ledger, you will have 1,60,000, and in return, this will become maybe 40,000 shares of rupees 4 each. So this will be 1,60,000 to 1,60,000. This will be in June 2012. In June 2013, that is a year later, the company in the general meeting resolved to consolidate 20 shares of rupees 5 each, rupees 4 paid per share, into 1 share of rupees 100 each, rupees 80 paid up. Now your shares are of rupees 5 each. So this will be equity share capital. You will cancel of rupees 5 account debit. This will be 4,000 into 4 paid up. The face value may be 5. However, the paid up value is 4, and hence the working will be based on that. So this is, let us say, 1,60,000 to equity share capital. This time around, these are shares of rupees 100. So maybe 1 share becomes 20 shares joined to become 1 share. So 40,000 divided by 20, you will have, I believe, 2,000 shares. So this is 2,000 shares. Each share is now worth 80. Remember, your paid up value was 4 per share. Into 20 will become 80. In your ledger, there will be 1,60,000. Pass the entries and show how the share capital will appear in the notes to the balance sheets as on 31st December 11, 31st December 12, and 31st December 13. So when you go to this case, let us say, this is done a little later. So when you go to this case, let us say there is a capital reduction over here. Just a second. Yes. So your entries would be share capital account debit to share capital to start with. Then again share capital account debit to share capital. Shares of 5 becoming shares of 100 rupees, as you can see. In your balance sheet, you will have authorized, issued and subscribed and paid up capital. On 31st December 11, you had 20,000 shares of rupees 10 each, comma rupees 8 paid up. So that is what you will write down, 1,60,000. Next, on the next balance sheet, you will have 40,000 shares of rupees 5 each, rupees 4 paid up. That is 1,60,000. Authorized capital will still be based on 2 lakhs. And next, you will have 2,000 shares of rupees 100 each, rupees 80 paid up. Are we clear with this? Yes. So this is question number 1. This is on conversion. Then we have question number 2. C Limited had 5 lakh authorized capital on 31st December 2011. Divided into shares of rupees 100 each. So this is 5 lakh shares of rupees 100 each, out of which 4,000 shares were issued and fully paid up. So it is not necessary that all the authorized shares are issued. Over here, 4,000 shares are issued and fully paid up, which means 4,000 into 100, which will come to, I think, 4 lakhs. Okay. In June of 2012, the company decided to convert these shares into stock. So your journal entry will be equity share capital account debit to equity stock. The value will be 4 lakhs. And in June 13, the company reconverted the stock into shares of rupees 10 each. This time they are converting to shares of rupees 10 each, not 100, which means you will now have 40,000 shares of rupees 10 each, fully paid. So your entry will be equity stock account debit 4 lakhs to equity share capital into bracket rupees 10. That is 40,000 shares of rupees 10 each. Pass the entries and show how the share capital will appear in the notes to the balance sheet in each of these respective years. So if I look at these entries, you will say equity share capital account debit to equity stock. You will have 2 equity stock, and then when you reconvert equity stock account debit to equity share capital, this time around there will be 10 shares. Now in the beginning you had equity shares, that is, I think, 4,000 shares of rupees 100 each. Next, there is equity stock. So we'll say something like this: equity stock worth 4 lakh, which is equivalent to 4,000 equity shares of rupees 100 each. That is what we will note down. And then in the next year, you will again have shares. So that is 40,000 shares of rupees 10 each. Remember, your authorized capital will also proportionately change. So this is regarding conversion from shares to stock. One of the May 23 exam questions also had these adjustments. So over here, you will have opportunities to score easily as well. So we will discuss the other things, but if I were to jump to your homework section where you have question number 7 behind, if we just discuss this right now on your homework section, question number 7, this is the May 23 paper. And if you see the adjustments here, X Limited had 1 lakh rupees of equity share capital divided into 1,000 shares of rupees 100 each. Again, X had 1 lakh rupees equity share capital, that is 1000 shares of 100 each, out of which 80 per share was called up and paid up. So it's a partly paid up share. 1000 shares of rupees 80 each in my ledger, I'll have 80,000. It had 1500 cumulative preference shares of rupees 100 each, fully paid. Intangible assets included goodwill of 80,000 and patents of rupees 27,800. The preference dividend are in arrears of 33,000. So these are yet to be paid, but this will be merely disclosed. Now, if X resolves to subdivide the shares of into 10,000 shares of rupees 10 each face value, of which rupees 8 per share is called up and paid up, then what will be the journal entry? At the end, they are asking you to pass the journal entries, ignoring the dates. Your journal entry over here is similar to question number 1, where you will say equity share capital account debit. Earlier these were shares of rupees 10 each. To equity share capital, these are now shares of rupees. Earlier these were shares of rupees 100 each. I think 100 each. Now they become shares of rupees 10 each. Remember, the paid up value in your ledger, you don't have the face value necessarily, you have the paid up value. Earlier these were 1000 shares, I think of rupees 80 each in your ledger, paid up capital, and hence this will be 80,000. 2, you will have now 10,000 shares of rupees 8 each, 80,000, and that's about it. Next, if X resolves to convert 1000 equity shares of rupees 100 each, assume they're fully paid, into 1 lakh worth of stock. Remember, for you to convert into stock, the shares have to be fully paid. So over here, if this is a separate transaction, your entry will be equity share capital account debit 1000 into 100, that is 1 lakh, to equity stock. You will just say equity stock, which is worth 1 lakh, and that is about it. Next, the preference shares are to be converted into 11% unsecured debentures of rupees 100 each, including for arrears of dividend. So over here, for the preference shares, whatever are the preference shares, 1500 shares of rupees 100 each. So this will be preference share capital account debit. I think 1,50,000, 1500 shares of rupees 100 each. There's also an arrears of preference dividend, but I can't debit it because it's not credited. And against that, I'm issuing 11% unsecured debentures. But that is issued for both the preference shares, that is 150 plus 33 of arrears of dividend. This time around, it is paid for both. So this is 1,83,000 and hence 33,000 will go where? Think and tell me. So this will go to the capital reduction. Why? Because this payment is happening, let's say, as a part of the reduction scheme, and hence it will be routed through the capital reduction account. Next, patents and goodwill are to be written off. They are again written off as a part of the scheme. So capital reduction account debit to goodwill to patents. Whatever is the amount, you will take that. Like goodwill over here is 80 and patents is 27,800. So this will be a total of 1,07,800. Are we clear with this? So this is kind of an exam question application of something which can be like question 1 and 2, which can come in your main exams. Okay, next is question number 3. I'll mark this as important. Acha, for revision, you can mark question 7 of your homework section as important for your LDR because that has coverage of 1 and 2 both. So if you revise question 7 from your homework section, that is a May 23 paper, you will be able to cover 1 and 2 automatically. Okay, next you go to question number 3. It's a typical internal reconstruction question, and hence we will try to do that completely. So over here, you will have question number 3. Now the balance sheet of A and company. Now typically what you do is, if you realize there's an internal reconstruction question, you see at the end what is asked. You're requested to show the journal entries reflecting the above transactions, including the cash transactions, and prepare the balance sheet of the company after completion of the scheme. So over here, you are asked to pass the journal entries, and you are also asked to prepare the balance sheet. But for journal entries, it is also advisable as a working note to prepare the capital reduction account, because at the last journal entry, you also have to figure out how much money is going to the capital reserve. So once you realize that, you prepare the format in your exam, maybe keep 2 sides, 1.5 to 2 sides, depending on the size of the question. For the journal entries, prepare journal of the company, then maybe 1/3 of a side as a working note 1 for capital reduction account, and then a schedule 3 format of the balance sheet will be prepared. You'll write down everything in the balance sheet, but you'll not write down the numbers, and then you'll prepare a notes to accounts on share capital, authorized, issued, subsidized and paid up capital. You'll keep dash, equity shares of dash each, and for preference shares as well. So you will prepare the entire structure, and then for each adjustment, pass the entry, give one effect, give the second effect, and you should be sorted. So over here, when we look at this entire balance sheet, let us say a balance sheet is given to you. You can glance through the balance sheet. For every item, we will try to discuss the journal entries side by side. Okay, so that we are clear of the journal entries as well as of the application. So over here, the court approved a scheme of reorganization to take effect on 1st January 11. whereby preference shares are to be written down to 75 and equity shares to rupees 2 each. Currently my preference shares are of 100 each. They have to be written down to 75 and hence 4,000 into 75. That is 3 lakhs. So your preference share capital account debit 4 lakhs to preference share capital into bracket 75 3 lakhs to capital reduction, as you can see 1 lakh, and hence you will post 1 lakh in the capital reduction account on the credit side. As you can see over here, you will have 1 lakh posted on the capital reduction account over here. Okay, next you have equity shares. Currently there are 75,000 shares of 10 each, so this will be 75,000 into 2. So this is equity share capital into bracket 10 account debit 7 lakh 50 to equity share capital 1 lakh 50, and remaining 6 lakhs will go to the capital reduction. It's a standard adjustment. Take 6 lakhs to the capital reduction, and now in your equity shares you will have 75,000 shares of rupees 2 each. Now point 1 is done. Point 2 of the preference share dividends which are in arrears for 4 years, 3/4 is to be waived off and equity shares of rupees 2 each are to be allotted for the remaining quarter. So what is the total preference dividend? It is going to be 4 lakhs into 6% into 4 years. This is your total dividend, out of which 3/4 is waived off, so there will be no entry. And for 1/4 you are issuing equity shares. So this will be what? 4 lakhs into 6% into 4 into 1 by 4. This will be 24,000. So this will be something account debit to share capital because you don't have any liability. This will be capital reduction account debit 24,000 to share capital 24,000, and this will result in issuing, I believe, 1200 shares. 12,000 shares of rupees 2 each fully paid for a consideration other than cash. So share capital will increase by 12,000. Accrued interest on debentures to be paid in cash. So your journal entry will be accrued interest 22,500 to bank 22,500. That's about it. So you will reduce your bank balance accordingly. Debenture holders agree to take over freehold property whose book value is 1 lakh at a valuation of 1 lakh 20. So you are taking it over at 20,000 higher. So freehold property account debit to capital reduction, there will be a 20,000 adjustment over here. Freehold property account debit to capital reduction. So your freehold property now goes to 1 lakh 20, and this 1 lakh 20 will be settled to pay debentures. So this will be in part payment of their holdings and to provide an additional cash of 1,30,000 secured by floating charge on the company's assets at an interest rate of 8%. So you will have debentures account debit. Let us say 375k debentures, you're not fully paying them off. You're paying them off to the extent of 1,20,000. So this will be debentures account debit 1,20,000 to freehold property 1,20,000. They're not foregoing anything. And then further they're bringing in 1,30,000. So bank account debit to debentures 1,30,000. So over here, if you go to see, you will have debentures account debit to freehold property and then bank account debit to debentures 1,30,000. Perfect. Next you will have patents and goodwills to be written off, inventories to be written off, amount of 68,500 to be provided for bad debts. So all of this, can I say assets are to be written off? So this will be capital reduction account debit to patents 37,500, to goodwill 1,30,000, to inventory 65,000, to provision for bad debts or debtors 68,500. So all of this will go as a part of a single transaction. Patents, goodwill, inventory, provision for bad debt, and even P&L debit balance which is there, you have to write it off. So we'll write it off in this entry. Alternatively, you can even write it off in some other entry. So this is your capital reduction adjustment. Next, remaining freehold property to be revalued at 387,500. Now how will you find the remaining freehold property? Currently the freehold property was 425. This increased by 20,000. Freehold property account debit from 1 lakh to 1,20,000 we went, and then you settled 1,20,000, and hence what you are left over is with 3,25,000, which is going up to 387,500. So there's an increase of 62,500. So this will be freehold property account debit to capital reduction 62,500. That's an increase in the property value. Again, because it is arising out of the scheme, we will adjust it against the capital reduction. Trade investments to be sold for 1,40,000, bank account debit 1,40,000, two trade investments. You will have, let us say, 55,000, and hence there is a big gain, 1,40,000 minus 55. There's an 85,000 gain, which will be again taken into the capital reduction account, as you can see over here. Next, you will have directors to accept shares. Directors to accept in settlement of their loans as to 90% by allotment of equity shares of 2 rupees, 5% in cash, and balance 5% being waived off. So directors' loans are 1 lakh. Your entry will be directors' loan account debit 1 lakh, to equity share capital 90,000, to bank 5,000, and balancing figure 5,000 will be to capital reduction account. So over here, again, this is issue of if I think shares are of rupees 2 each, 45,000 equity shares for a consideration other than cash. Okay. There were capital commitments totaling to 2,50,000. Capital commitment means money that you have committed to spend for capital projects. These contracts are cancelled against a payment of 5%. So for commitments worth 2,50,000, which was not appearing in the balance sheet, you are cancelling them and paying 12,500. Your rental will be capital reduction account debit to bank because there is no liability appearing in your books. So capital reduction account debit to bank. This is 12,500. And once that is done, you are said ignore taxation, ignore cost of the scheme, past journal entries. You look at your capital reduction account, and over here, by the way, there is no balance. Coincidentally, the account fully balances, and hence there is nothing else to be taken. When you prepare your balance sheet, as you can see over here, we have highlighted and reduced. And we will prepare our balance sheet in the regular Schedule 3 format, where you will say share capital, equity, preference shares, and then you will also mention of the above, so many shares are issued for a consideration other than cash. So that is discussion for question number 3. You will mark this as important. Next, you go to question number 4. Now, in question number 4, you have been given a balance sheet and then of a particular company. I think the name of the company is Rebuilt Limited. So, this is balance sheet of Rebuilt, which is given on a particular date. The company is not earning enough profits. The company is not earning profits, is short of working capital, and a scheme of reconstruction has been approved by both classes of shareholders, maybe equity and preference both. A summary of the scheme is as follows. So you have a lot of data given, but at the end, what is asked? Show journal entries how the financial books are affected by the scheme and prepare the balance sheet. After the reconstruction, the nominal capital is reduced, is to be increased to 650 for preference shares, 750 for equity shares. So this will help you in authorized share capital. So over here, when we look at each of these adjustments, one by one, again, you have to pass the journal entries, go with that same format. Equity shareholders have agreed that for their shares of 50 would be reduced to 2.5 by cancellation of 47.5. So this is share capital account debit, the entire 7,50,000 to only 15,000 into 2.5, 37,500, and hence the remaining, I believe 7,12,500 will go to the capital reduction. They have also agreed to subscribe for 3 new equity shares of rupees 2.5 each for each share held. So this is 15,000 into 3, which is 45,000. 45,000 ke shares are issued for cash. 45,000 into, I believe 2.5 comes to around 1,12,500. Bank account debit to share capital 1,12,500. So if you go over here, 7,12,500 as we discussed will go to the capital reduction. Bank account debit to share capital 1,12,500. Okay, the preference shareholders have agreed to cancel the arrears of dividend, so there will be no entry, and to accept for each 50 share 4 new 5% preference shares of rupees 10 each plus 6 new equity shares of rupees 2.5 each, all credited as fully paid. So over here my entry will be preference share capital account debit 6 lakhs. Okay, against that you will issue what? 4 new shares for each preference share. How many preference shares are there? 12,000 into 4, 48,000 of rupees 10 each into 10. So that is 4,80,000 plus 6 new equity shares of 2.5 each. 6 into 2.5 into, let us say, 12,000. So this is 1,80,000. So I believe preference share capital account debit 6 lakhs, 2 new preference share capital of rupees 10 each, 4,80,000. 2 equity share capital, this is 1,80,000, and there is a balancing figure now coming on the debit side, which will still go to the capital reduction account. So this is 4,80,000, 1,80,000, and balancing figure of 60 will go to the capital reduction account. Okay, next you will have lenders of the company for 1,50,000 have agreed to convert their loan into shares, and for this purpose they will be allotted 12,000 preference shares of rupees 10 each and 12,000 new equity shares of rupees 2.5 each. So 12,000 into 10, this will be 1,20,000. 12,000 into 2.5, I think this will be 12,000 into 2.5 will be 30,000, and as a result this will be loan account debit 1,50,000 to preference share capital 1,20,000 to equity share capital 1,30,000. Okay, next you have, for example, directors have agreed to subscribe to cash for 40,000 new shares of rupees 2.5 each, in addition to any shares that are already subscribed. This is just a normal share issue entry. Bank account debit to equity share capital 40,000 into 2.5. I believe this will be 1 lakh. Over here, this is 1 lakh. Next, you have of the cash received by issue of equity shares, 2 lakhs is to be used to reduce loan due by the company. So your entry will be loan account debit to bank 2 lakhs. You will pass the entry loan account debit 2 lakhs to bank 2 lakhs, and that's about it. Next, you will have equity share capital is cancelled to be applied to write off the debit balance in the P&L and to write off 35,000 from the value of the plant, and any balance remaining is to be used to write down the value of trademarks and goodwill. So over here, usually the balance in the capital reduction will go to the capital reserve. In this case, will you take it to the capital reserve? No. In this case, we will take it where? Well, we will take it against the trademarks and goodwill. So over here, your entry will be capital reduction account debit to P&L 4,51,000, to plant 35. So this is P&L account, capital reduction account debit to P&L to plant. Now, after doing all of this, in my capital reduction account, there will be a 166,500 balance. Now, usually I credit it to the capital reserve, but because the question tells me that I'll have to adjust it from trademarks and goodwill, I will reduce 166,500 from the trademarks and goodwill, which is, I believe, 3,18,000 minus 166,500, and 151,500 will be ultimately, as you can see over here, trademarks and goodwill appearing in my final balance sheet. Are we clear with this? Okay, so you'll drop the balance sheet based on that. Now, question number 5 we have kept, but this has been deleted by the ICAI because it has some impact of adjustments which are there in liquidation. So for the time being, we can skip that question because ICAI has deleted it. Though, if you want to review, you can do that, but ICAI has removed that question from its new study material from May 24, May 25 onwards because it has some impact of liquidation. Next, you go to question 6. The balance sheet of Vaibhav is as follows. You have been given the balance sheet. Following is a scheme of internal reconstruction which is sanctioned. At the end, देखो क्या पूछा? Pass journal entries and show the balance sheet after giving effect to the above. So when I take each of the items, all existing equity shares are reduced to 40 each. There are maybe 2 crores divided by 100, that is 2 lakhs. So this is 2 lakhs into now 40. This is 80 lakhs. So equity share capital account debit 2 crores to equity share capital 80 lakhs, and capital reduction you will take 1 crore 20 lakhs. So over here, I think question 6 for Vaibhav, this is 1 crore 20 lakhs. Okay, the preference shares are reduced to rupees 60 each. So these are maybe 1 crore divided by 100. So this is 1 lakh preference shares. They will now become of rupees 60 each. So this is 60 lakhs. 40 lakhs will go into the capital reduction. Preference share capital account debit to preference shares to capital reduction. The rate of interest on existing on debentures is increased to 6%. The debenture holders surrender their existing debentures of 100 and exchange the same for fresh debentures of rupees 70 each for each debenture held. 5% debentures account debit 80 lakhs to 6% debentures. These are going to be 80,000 into 70, 56 lakhs, and hence the remaining 24 lakhs will go to the capital reduction account. Perfect. Fixed assets are to be written down by 20%. So this will be, I think, 50 lakhs. Current assets are to be revalued at 90 lakhs. So current assets are currently 2 crore. So this will be reduced by 1 crore 10 lakhs. Investments are to be brought to their market value, which is, I think, 1 lakh lower. Okay. And if there's any P&L debit balance, you'll write it off. So over here, there will be capital reduction account debit to fixed assets, to current assets, to investment, and to P&L debit balance. Perfect. Nothing tricky over here, I would say. One of the creditors of the company to whom the company owes 40 lakhs decides to forego 40% of this claim. So 16 lakhs is foregoing. And the creditor is allotted 60,000 shares of rupees 40 each in full and final settlement. So 60,000 into 40 comes to 24 lakhs. So your entry will be trade payables account debit 40 lakhs to share capital 24 lakhs to capital reduction 16 lakhs. Perfect. Next, the taxation liability is to be settled at 3 lakhs. What is the taxation liability? 2 lakhs. So your entry will be provision for tax account debit 2 lakhs to bank 3 lakhs, and hence balance 1 lakh will go to the capital reduction account, and that's about it. After this, you will look at the balance in the capital reduction account, and whatever is the balance will be taken to the capital reserve if nothing is given. It is decided to write off the P&L debit balance. Even if it was not given, we would have written it off. Are we clear with this? So question number 6. Then you go to question number 7. Following is a summary balance sheet of ABC for 31st March 2011. So you have the balance sheet. The following scheme of reconstruction has been finalized. preference shares would give up 30% of their capital in exchange for allotment of 11% debentures to them. So my entry will be preference share capital account debit and giving up 30% of the capital. For the remaining 70%, it is implied that debentures are issued. So currently in my preference share, I will remove the entire 6 lakhs. Remember, I am giving up 30%. And for the remaining 70%, it is implied that debentures are issued to preference share capital account debit. 2 debentures. I believe 70% of 6 lakhs will come to what? Is it 4 lakh? 4 lakh 20. Yes, 4 lakh 20 and 2 capital reduction will be 1 lakh 80. Sometimes the student makes a interpretation error over here where a student thinks that it is against this 30% that his debentures are issued. No, you have given up 30% and hence if the debentures are issued, they are for the balance portion. So if I review this in question number 7, I'll have 8% preference shares, 2 11% debentures, 2 capital reduction, 1 lakh 80. I would say this is a slightly important because it is not usually a common entry. Debentures having a charge on plant and machinery would accept plant and machinery in full settlement of their dues. Now, I don't know the market value of plant and machinery, but let us assume it is the same as the book value, that is 9 lakhs, and debentures are 12 lakhs. So rent will be debentures account debit 12 lakhs to plant and machinery 9 lakhs and 3 lakhs will go into the capital reduction account. Perfect. 12 lakhs, 9 lakhs and 3 lakhs. Second entry. Third, inventory equal to 5 lakhs in book value will be taken over by trade payables in full settlement of their dues. So this is trade payables account debit 5 lakh 92 to inventory 5 lakhs and 92,000 will be going into the capital reduction account. Okay. Next, you will have investment value to be reduced to market price. Same as the last adjustment. Market price is 55,000. So capital reduction account debit to investment 13,000. But beyond that, is there anything else? The company would issue 11% debentures of 3 lakhs to augment its working capital after settlement of bank overdraft. So your entry will be bank account debit to debentures 3 lakhs and then the money that you have will be used for paying off bank overdraft as well. Bank overdraft account debit to bank 1 lakh 50. So there will be bank overdraft account debit to bank 1 lakh 50 as it is told and then bank account debit to debentures. That's about it. If there is any other P&L debit balance, even if it is not given, we will write it off. This is 4 lakh 5,000. So this is capital reduction account debit to P&L debit balance. This is 4 lakh 5,000. You will try to balance the capital reduction account and you will see 1 lakh 54,000. And if nothing is given, unlike the earlier question, I will take it to capital reserve. And that is about it. Again, not a very important question. I would say question 3 was an LDR question. And now next question, which is question 5, is also an LDR question. This is a question which involves share surrender. So let us review this once. The summarized balance sheet of Revise Limited on 31st March 11 was. You have been given this balance sheet. It was decided to reconstruct the company, for which necessary resolution was passed and sanctions were obtained from the appropriate authorities. Accordingly, it was decided that each share is subdivided into 10 fully paid shares of rupees 10 each. It is subdivision. They are not letting go of their capital. It is subdivision, which means 10,000 shares of rupees 100 each will now become 1 lakh shares of rupees 10 each. Your journal entry will be equity share capital account debit 10 lakhs to equity share capital, let us say 10 lakhs. That's it. Point 1. So if I were to review this, just a second, over here for share surrender as well. So this is, I think, question 8. Equity share capital account debit 10 lakhs to equity share capital 10 lakhs. Now comes the important entries. After subdivision, each shareholder shall surrender to the company 50% of his holding. Okay, so shares will still be 10 lakhs into 50%, that is 5 lakhs worth of shares. So this is maybe 50,000 shares of rupees 10 each for the purpose of reissue to debenture holders and trade payables as necessary. So a journal entry will be equity share capital account debit because these are shares surrendered coming back to the company. Equity share capital account debit to share surrender. This will be at 5 lakhs. Perfect. आगे क्या? Out of the shares surrendered, now these are shares which are surrendered and lying with the company. At this point, your issued capital is only the remaining 50,000 shares of rupees 10 each. 50,000 are with the company only. 10,000 shares of rupees 10 each are to be converted into 12% preference shares of rupees 10 each, fully paid. Now the natural instinct over here is to pass the entry equity share capital account debit to preference share capital. But if you debit the equity share capital further, earlier you had a 10 lakh share capital, out of which you have debited 5 lakhs, is your remaining share capital 5 lakhs only? Out of that 5 lakhs, nothing is converted. But out of the shares which are surrendered, some shares are converted. So technically, even if you want to pass the entry will be share surrender account debit to share surrender. In the share surrender, certain equity shares were there, which are now becoming preference shares. Institute over here does not pass any entry. At the time of conversion, it will pass an entry though when these shares are actually given. So over here, there will be no entry. This is the important point. The claims of debenture holders shall be reduced by 75%. Debenture holders claims. Debentures over here is 2 lakhs. Accrued interest is 24,000. So your total gains is 2,24,000 into 75%. Can I say 1,68,000? Your entry will be 12% debentures account debit, accrued interest account debit totaling up to 1,68,000. In consideration of the reduction, the debenture holders shall receive preference shares of rupees 1 lakh, which are converted out of the shares surrendered. Now this is where you will make a mistake. You will generally pass an entry that debentures account debit, accrued interest account debit to preference share capital. No. Remember, for you as a company, you are in the books of the company. For you as a company, nothing is paid out of your pocket. It is some shareholder who has surrendered the shares, and out of the share surrender balance you are giving shares. You are not paying anything to the debentures, and hence for 1,68,000 you will pass the entry debentures account debit, accrued interest account debit to capital reduction. Remember that. Grill that into your mind. To capital reduction 1,68,000, and then when shares are issued, they are issued from the share surrender balance. Then your entry will be share surrender account debit to preference share capital 1 lakh rupees. So if you go to see, be very careful, and if you get this correct, you can try trade creditors on your own. Pause and try on your own. So this is 12% debentures account debit 1,50,000, accrued interest account debit 18 to 168. Sir, why entire 168? Because you are not paying it. It is your shareholder who is paying it directly. And hence from your pocket nothing is going, it is going from the share surrender balance. And then share surrender account debit to 12% preference share capital. Okay, this is point D. Next you go to point E. Trade payables shall be reduced to 50%. So currently trade payables are 72,000. They will directly be reduced to 50%, that is 36,000. And it is to be settled by issue of equity shares of rupees 10 each out of the shares surrendered. So this 36,000 is also settled, but not by the company paying anything. This is also out of the balance from the share surrender. So basically the entire creditors of 72,000, 36 which they are foregoing SA, and remaining 36 which is paid out of the surrender money, not from our money. And hence trade payables account debit kitna hoega? You will definitely make a mistake. Kitna hoega? 36 or 72? 72. To capital reduction. Sir, but we are they are foregoing only 50%. हाँ, वो तो forego कर ही रहा है. For the remaining 50% also we are paying out of the share surrender balance, not from our balance. And hence the entire 72, for us we are not paying anything. Trade payables account debit to capital reduction, and then share surrender account debit to equity share capital 36,000. So over here you will have shares trade payables account debit to capital reduction 72,000 and share surrender account debit to equity share capital 36,000. Perfect. Next, what do you have? Balance in the P&L to be written off. That's capital reduction account debit to P&L. This is, I think, 6 lakhs. The shares surrender and not reissued shall be cancelled. Okay, these are shares surrendered and not reissued. They will be cancelled. So whatever is the balance in the share surrender account will be transferred, let us say, to the capital reduction account. So if I look at my share surrender balance, there will be 5 lakhs. Then 12% preference share capital, 36,000 for equity share capital, and 3,64,000 is your capital reduction. And 364 over here will be transferred to the capital reduction, and then we'll balance the capital reduction, and there'll be a 4,000 balance in the capital reserve. So also all of these sums are study material sums. So even if you don't have the book handy, and if you have the institute study material, that should work. Majority of the remaining sums are from RTBs, MTBs and past exam questions. So let us review that. So this is taking care of share surrender. If you want to also tackle one more sum of share surrender side by side, we'll go to question 16, which also has certain adjustments for share surrender, which we can discuss. So over here, let us review question number 16, which we have marked as important and which is something that you will also look at for your LDR. Because there is share surrender as well as regular capital reduction. In the earlier problem, you largely had share surrender only. Here, along with surrender, you also have capital reduction. Following information is there from the balance sheet of Ruby as on 31st March 23. So you have the entire balance sheet. The arrears of preference dividend amounted to 5,60,000. The company had suffered losses since the last 3 years due to bad market conditions, and it hopes for a better position in the future. The following scheme of reconstruction has been agreed upon and has been duly approved by all concerned. Okay, so there is a capital reduction scheme. Ultimately, karna kya hai? You are required to pass journal entries for giving effect to the above and also drop the balance sheet. Let's go one by one. Equity shares are to be converted into 6 lakh shares of rupees 10 each. Converted. 6,000 shares of 100 will become 6 lakh shares of rupees 10 each. Your journal entry will be share capital account debit into bracket rupees 100 to share capital into bracket rupees 10. Your entry will be same, 60 lakh rupees. Are we clear with this? Okay, that is sub point 1, subdivision. Sub point 2, equity shareholders to surrender to the company 80% of their holding. 60 lakhs into 80%, 48 lakhs. Your entry will be equity share capital account debit, 48 lakhs to share surrender, 48 lakhs. Perfect. Equity share capital to share surrender, 48 lakhs. Preference shareholders agree to forego their right on arrears of preference dividend, in consideration for which 7% preference shares are to be converted into 8% preference shares. They are not foregoing any rupee value. They are foregoing their arrears of dividend, which were in any case in the notes. Your entry will be 7% preference share capital account debit, 40 lakhs to 8% preference share capital, 40 lakhs. So there is no capital reduction or share surrender impact over here. Okay. Point 4, trade payables agree to reduce their claims by 1/4. So your trade payables are currently, I think, 49 lakh 20. 1/4 of that, I think, will come to 12 lakh 30. They agree to forego their claim by 1/4 in consideration of getting shares of 10 lakhs out of the shares surrendered. Again, am I paying from my pocket? No. This is a shareholder surrendering shares out of which I have paid off. And hence the entry will be share surrender account debit to equity share capital. And trade payables, 1230 for me, liability is going off trade payable account debit to capital reduction. So my entry will be trade payables account debit, which is reducing by 12 lakh 30 to capital reduction, 12 lakh 30, and then share surrender account debit 10 lakhs to equity share capital 10 lakhs. These are the important entries, I would say. Share surrender account debit to equity share capital. This is the shares issued out of the balance of shares surrendered, and trade payables account debit. The entire 12 lakh 30 for the company as a whole is a liability which is reduced. So over here to capital reduction. Now the directors agree to forego the amounts due on the loan. So for directors loan, there is 8 lakh 80. That is loan from directors account debit 8 lakh 80 to capital reduction. Surrendered shares not issued are to be cancelled. So whatever is the balance in the share surrender account, if I go to see the balance in the share surrender account, 48 lakhs, 10 lakhs are issued, that is 38 lakhs will be transferred to the capital reduction account. So this is by share surrender. Next, assets to be reduced, patent to nil. So we'll write off patent by 8 lakhs. So capital reduction account debit 2 patents, 8 lakhs. Plant and machinery by 8 lakhs. So 2 plant and machinery, another 8 lakhs. Inventory 6 lakh 80. 2 inventory 6 lakh 80. Trade receivables to the extent of 34 lakhs are considered good. In your books, trade receivables are 47 lakhs. 34 lakhs are considered good. So 2 trade receivables, 13 lakhs. So all of this is reduction. So capital reduction account debit 2 patents, 8 lakhs. 2 plant and machinery, 8 lakhs. 2 inventory 6 lakh 80, 2 trade receivable 13 lakhs, and if there's any P&L debit balance 16 lakh 80, we will also knock that off. Okay, sir. Revalued figures of building is accepted at 14 lakhs. In your books, I believe they are at 11 lakhs. So that is a 3 lakh increase. Building account debit to capital reduction 3 lakhs. Bank loan is repaid. That is nothing but loan account debit to bank 6 lakhs. That's it. Any surplus after meeting the losses should be used in writing off the value of the plant further. So again, the balance in the capital reduction will go to the plant and not to capital reserve. And expenses of reconstruction amounted to 1 lakh 20. So this is capital reduction account debit to bank 1 lakh 20. Further 80,000 equity shares were issued to existing members for increasing the working capital. They subscribed and paid up. 80,000 shares, I believe these are shares of rupees 10 each now. That is 8 lakhs. Bank account debit to equity share capital at the end of it. There will be bank account debit to equity share capital 8 lakhs. Capital reduction account debit to bank, this is for expenses 1 lakh 20, and that's about it. You will balance the capital reduction account. You will see the balance will be transferred to plant and not to capital reserve as it is given in the question. Is everyone clear with this? Yes? Okay. So this is your question number 16 done. Now earlier if you go to see question number 15 is very similar. In fact, it is exactly the same. As question number 6, I think that Vaibhav Limited wala question that we discussed. So there was a Shine which has information as on 31st March 11. You have this data. All existing shares are reduced to rupees 4, preference shares to 60. It's exactly the same. Rate of interest on debentures increased to 9%. They surrendered 100 shares in exchange for new 80. वहाँ पे 170 था. Investors at market value, taxation liability at 525, balance to be written off, and the balance of current assets after settlement of taxation liability is revalued at 157,500. If you go to see, it is exactly the same, just that this is after settlement of taxation liability. So you will reduce the payment for tax and then do the revaluation. One of the creditors gives up 50% of the claim and balance is settled through shares. PP is written off. So I would say this is exactly similar to 6. You don't need to read it again. You can even cancel this. This is more for practice. RTP November 21 question. Okay. Next you will go to, let us say, question number 9, I believe. Okay, this was an important question for your LDR as well. The summarized balance sheet of Z as on 31st March 2017 is as under. So you have the entire balance sheet given to you for Z, and on the next page, preference dividend are in arrears for the last 2 years. Now this is a very common and a very typical adjustment which Institute loves asking you. Mr. Y holds 60% of the debentures and Z holds 40% of the debentures. Moreover, 1,60,000 were also payable to X and Y and Z as trade payable. So when I look at the debentures, where are the debentures? So debentures over here are 16 lakhs. Can I say 60% of that is held by Y? 40% of that is held by Z. So 60% of 16 lakhs, I think will come to 9,60,000, whereas this will come to, I believe, 6,40,000. Okay, fair enough. The following scheme of reconstruction has been agreed. All equity shares are to be converted into fully paid shares of rupees 5 each. Currently shares are what? 5 lakh shares of 10 each. So this is share capital account debit 50 lakhs to share capital 25 lakhs to capital reduction 25 lakhs. So over here, this will be, just a second. Yes, 25 lakhs coming over here. Question number 9. Next, you will have the preference shares are reduced to 50 and each preference shareholder agree to forego their arrears of preference dividend, in consideration of which 9% preference shares are to be converted into 10% preference shares. So basically, it will be 9% preference share capital into bracket rupees 100 account debit. This will be for 20 lakhs to 10% preference share capital 10 lakhs to capital reduction 10 lakhs. Perfect. 10 lakhs is going in the capital reduction. Okay, now is the important adjustment for this Y and Z. Mr. Y and Z agreed to cancel 50% of their respective total debt, including interest on debentures. Acha, there's some interest on debentures as well. If this is 1,60,000, I can say if debentures were held by Y and Z, can I say this interest also to the extent of 96,000 and to the extent of 64,000 will be attributable to Y and Z 60/40. Acha, Y and Z agreed to cancel 50% of their respective total debt, including interest on debentures. Total debt will include debentures, then it will include interest, it will also include the trade payables. Uska 50%. So if I look at Y, for example, this is 9,60,000. Then this is 96,000. And what is the payable amount? I believe 1 lakh. And hence, your total debt is 9,60,000. And I think 11,56,000 into 50%. 5,78,000 will go to the capital reduction account. Mr. Y and Z also agreed to pay, that is Y and Z will bring in 1 lakh and 60,000 respectively in cash and to receive 12% new debenture for the balance amount. So if I pass an entry for Y and if I do it properly for Y, hopefully you should be able to do it for Z as well. So your entry will be, let us say for Y, your entry will be debentures account debit, let's say 9,60,000. Interest, accrued interest account debit, pura 9,60,000. This is what? 96,000. Trade payables account debit 1 lakh. Acha, apart from this, they are also bringing in money, bank account debit. I think 1 lakh. Y is bringing in 1 lakh. To capital reduction. This is where you will take the total debt, which is, I think, 11,56,000 into 50%, 5,78,000 in the capital reduction account, and the balancing figure will be 12% new debentures. this will be what? 578 minus, let us say, all of these values. I think 678 by any chance. And if I were to be able to understand even briefly what is happening for y, you should try to do it for z on your own. So for y, you'll have 578 and 678. Wow, how did you get 578? Well, all your total debt into 50%, 9 lakh 60 plus 96 plus 1 lakh into 50%. You are foregoing. Further, 1 lakh is received and the balancing figure will come over here. For z, the same working will be again 6 lakh 40 plus 64 plus I think 60,000, that is 764 into 50% comes to 3,82,000. 3,82,000. So this will be again the same values, 6 lakh 40, 64, 60,000, bank account debit 60,000 and 3,82,000 will go into the capital reduction and balance will be new debentures. So this is the important adjustment and institute tries to twist and turn this adjustment. The persons relating to trade payables other than Y and Z, that is 1 lakh 60 nikal do, agree to forego 50% of their claims. So trade payables over here are 5 lakhs, out of which you remove I think 1 lakh 60 for Y and Z, that is 3 lakh 40 into 50%. So that is capital reduction account debit, trade payable account debit, 1 lakh 70 to trade payables account debit to reconstruction or capital reduction account as a case may be. Okay. The directors also waived off 60% of their loans and accepted equity shares for the balance. So directors loan account debit 1 lakh to capital reduction, or in this case if reconstruction account is asked to reconstruction, this is 60,000 and balancing figure will be to equity share capital 40,000. This is point number 6. Okay, next we have capital commitments of 3 lakhs were cancelled on payment of 15,000. Capital reduction account debit to bank 15,000. We have done this adjustment earlier. Reconstruction account debit to bank 15,000. Then directors refunded 1 lakh of fees previously received by them. So this is a new adjustment. Company ke liye they are getting 1 lakh. Now for whatever be the reason, here I have no further liability. So bank account debit 2. I'm not issuing any equity shares, no liability, nothing. So this is to reconstruction or capital reduction account. So this is bank account debit 1 lakh to capital reduction 1 lakh. Okay, next you have reconstruction expenses of 15,000. This is capital reduction or reconstruction account debit to bank 15,000. Perfect. Next you have all of these taxation liability settled for 75,000 and was paid immediately. So your tax liability currently is how much? 1 lakh. So this will be provision for tax 1 lakh to bank 75,000 to capital reduction, I believe 25,000. As you can see, 25,000 is going in the capital reduction account. Okay, and next you have a standard assets are evaluated as under. If you go to see land and building, I think is the only asset that is increasing from 30 to 32. So that's a 2 lakh increase. Other than that, plant, inventory, trade receivables, furniture, everything is decreasing. So you'll have this big entry where reconstruction account debit to plant, to inventory, to trade receivables, to furniture, investments. Achha, later they say you are required to prepare necessary journal entries for all the above transactions, including amounts to be written off. Include goodwill, patents, loss in the P&L and discount on issue of debentures. All of these items, even patents, goodwill are to be written off. So you goodwill, patents, P&L. Remember, goodwill should not be written off unless the question tells you. If it tells you, you write off. Otherwise, aisa nahi manenge ki goodwill is a fictitious asset. No, goodwill is a real intangible asset. And then if there is something remaining in the capital reduction, that is 7,75,000, that will be transferred to the capital reserve. Perfect. What are you supposed to do? Prepare bank account and reconstruction account. So usually for bank you do plus or minus in brackets. Here you will also prepare the bank account. Okay, so this is question number 9. It's a good question. Next, go to question number 10. Platinum Limited has decided to reconstruct the balance sheet since it has accumulated huge losses. The draft balance sheet before reconstruction is given to you. Over here there is this entire balance sheet, and following is the interest of Mr. Shiv and Mr. Ganesh in platinum. Remember in the last question we have Y and Z, similar 8% debenture, 12% debenture. The following scheme of internal RECO was framed and approved by the court. Uncalled capital is to be called up in full and shares are to be converted into equity shares of rupees 40 each. So currently shares, 50,000 shares of rupees 50 each, they are fully paid, but 1 lakh shares of 50 each are 40 paid, which means uncalled capital is 1 lakh into 10. That is 10 lakhs. Bank account debit 2. You can take that final call and all of that, but ultimately bank account debit to equity share capital will be 10 lakhs. Now you will have total 1 lakh 50,000 shares of rupees 50 each fully paid, which you will reduce. So 1 lakh 50 into 10, that is 15 lakhs. So your entry over here would be share capital account debit into bracket 50, 75 lakhs, to share capital 60 lakhs, to capital reduction 15 lakhs. So there will be two entries. If I go to see over here, this is for Shiv and Ganesh wala question number 10, bank account debit to equity share capital. This is for the uncalled capital, and then equity share capital. This is now 1.5 lakhs, 50,000 and 1 lakh of 50, and 1.5 lakhs to 40 to the capital reduction account, that is 15 lakhs. Fair enough. Okay. Next, you have the existing shareholders agree to subscribe in cash fully paid shares of rupees 40 each for 12 lakh 50. Nothing much over here. Bank account debit to share capital. Third point is highlighted, so it's a little important. Trade payables are given the option either to fully accept fully paid shares of rupees 40 each for amount due to them, or accept 70% of the amount due to them in cash. So you can either take shares, jitna aapka payable hai, you take those shares, or you take 70% if you want immediate cash settlement. Trade payables for 7 lakh 50 accepted equity shares, and the rest of them opted for cash towards full and final settlement. So if I go to see in my trade payables, I have 12 lakh 40. Out of 12 lakh 40 minus 7 lakh 50, there will be equity share capital. For remaining 4 lakh 90, they are settling in cash, so 70% must be the payment. So there is 3 lakh 43,000 is the payment, and 1 lakh 47,000 will go to the capital reduction. So what will be the journal entry? Trade payables account debit 12 lakh 40 to equity share capital 7 lakh 50. जितना ड्यू है उतना ही हम पे कर रहे हैं 7 lakh 50. To bank for the remaining 4 lakh 90, 3 lakh 43,000 is paid in cash. To bank 3 lakh 43, to capital reduction 1 lakh 47. So if you see over here, trade payables 1240 to share capital, to bank, and to capital reduction. Okay. Next, Mr. Shiv agrees to cancel debentures amounting to 2 lakhs out of the total debentures due to him. So he is giving up 2 lakhs and agrees to accept 15% debentures for the balance amount due. He also agrees to subscribe to a further debentures in cash amounting to 1 lakh. So for Shiv, your entry will be bank account debit, 8% debentures account debit 3 lakhs, 12% debentures account debit 4 lakhs. Bank account debit, Shiv is bringing in, I believe, 1 lakh. Bank account debit 1 lakh. To capital reduction 2 lakhs. So what they say is Shiv is agreeing to cancel debentures amounting 2 lakhs out of the total debentures. So out of the debentures worth 7 lakhs, he is letting go of 2 lakhs. But he is also bringing in 1 lakh. So your entry will be all his debentures account debit 3 lakhs and 4 lakhs. Bank account debit 1 lakh. To capital reduction 2 lakhs. And as a result, balancing figure, I believe 6 lakhs will go as new debentures. So over here for Shiv, you will have 3 lakhs, 4 lakhs bank debit, to capital reduction, and then 6 lakhs will go as new debentures. Now you go to Ganesh. Ganesh agrees to cancel debentures amounting to 50,000 of his total debentures and agrees to accept 15% debentures for the balance amount. Ganesh keeps it simple. 8% debentures account debit 1 lakh, 12% debentures account debit 2 lakhs, to capital reduction 50,000, to new debentures 2 lakh 50,000. Here he is not bringing in any cash. Perfect. 2 lakh 50,000. Okay. Land and building to be revived at 5184. I think this is going upward. Machinery at 7 lakh 20, computers at 4 lakhs, inventories at 350, trade receivables at 10% less than they appear in the balance sheet. So basically this is just adjustment of assets and liabilities like you usually do, and if there's any PL and debit balance, you'll write that off as well. Plant, computers, trade receivables, goodwill. Acha, goodwill bola hoga to write off, and to P&L. And land and building and maybe inventory. Whatever is going up, you will debit. Whatever is going down, you will credit. Outstanding expenses are fully paid in cash. This is 10 lakh 60. Outstanding expenses account debit to bank. And goodwill and P&L are to be written off, and the balance on the capital reduction against capital reserve. Even if this was not given, we would have adjusted against capital reserve. You are required to pass journal entries for the above transaction and draft the company's balance sheet immediately after reconstruction. So over here, you will pass the journal entries over here, and that's about it. There's nothing materially different or difficult over here. Okay, next you go to, this question 11 midway was printed. I think it is pertaining to another question. So in question 12, we call this as 12A, and 12A kind of ends over here. It ends somewhere over here. And then you have 12B, which is kind of a very small adjustment, which is similar to a July 21 exam question as well. So 12B as well as 13 are quite basic, simple problems. But question number 12A is a good question. You can mark it as important. Okay, you can even review this for your LDR. So let's complete this 12A. Following is the balance sheet of Star Limited. You have the entire balance sheet given, and you have some workmen's compensation fund and a Bombay Works, Chennai Works, and then in PP also Bombay Works and Chennai Works. Maybe this is like a factory. And there are certain investments for this workmen's compensation fund. So the only challenges over here is pertaining to these Bombay Works, Chennai Works plant, their workmen's compensation fund and their investments. Otherwise, it's a fairly standardized question. The reconstruction scheme was prepared and duly approved. The salient features of the scheme were as follows. The paid up value of the 7% preference share to be reduced to rupees 80, but the rate of dividend being raised to 9%. Paid up value of 7% preference shares reduced to 80, but the rate of dividend. So currently preference shares are having a value of 100. 9 lakhs. So this is preference share capital account debit 9 lakhs to preference share capital account. I think this is 9,000 into 80. I think this is 7 lakh 20 to capital reduction 1 lakh 80. Nothing much. Standard adjustment. Paid up value of equity shares to be reduced to rupees 10. This is 10 lakh of rupees 100 each. So this is 10,000 into rupees 100. So this is equity share capital account debit 10 lakhs to equity share capital 1 lakh, and 9 lakhs will go into the capital reduction. So this is 1 lakh 80 in the capital reduction, then this is 9 lakhs in the capital reduction. Okay, third adjustment, the directors to refund 50,000 of the fees previously received by them, done earlier. Bank account debit to capital reduction for 50,000. Debenture holders forego their interest of 26,000, which is included along with trade payables. So over here, there's trade payables account debit to capital reduction 26,000. So this is trade payables to capital reduction 26,000, and then earlier there was a director adjustment of 50,000. Nothing new here. The preference shareholders agreed to waive their claims for preference dividend, which is in arrears for the last 3 years. There will be no entry because preference dividend arrears is not appearing in the balance sheet, so there will be no entry. Point 6. B 6% debenture holders agree to take over Chennai Works at 425. So the entire Chennai Works is taken over at 425. वैसे, what is the balance of Chennai Works of the Chennai plant? 775. So 775 minus 425, if I go to see, there is a downward movement of 3 lakh 50. So Chennai Works will have to be remeasured down. So this is capital reduction account debit 3 lakh 50 to Chennai Works 3 lakh 50. So it comes down to 4 lakh 25,000, and then it is taken over by 6% debenture holders. And to accept an allotment of 1500 shares of rupees 10 each at par. So they are going to take Chennai Works. They are also going to receive shares. So basically the company is giving up Chennai Works. So you will credit Chennai Works. The company is giving up shares. You will credit the shares. Against that, I think the liability will be settled. And upon forming a company called as Zia to take over Chennai Works, they allotted 9,000 shares of rupees 10 each, fully paid at par to start. No. What is happening? Now, if I go to see, these 6% debentures are actually worth 3 lakh 50. Chennai Works is actually worth 7 lakh 75,000. And it is agreed to be taken over at 425. So, first of all, Chennai Works has to be brought down to 425. So, your entry over here to start with would be capital reduction account debit 3 lakh 50 to Chennai Works 3 lakh 50. So, Chennai Works is now 4 lakh 25,000 in your ledger. Now, what is happening? If you go to see, Star Limited is giving up Chennai Works. So, to Chennai Works would be 4 lakh 25. It is also giving its own shares. Kitne own shares? I believe 1500 of rupees 10 each. So that is 15,000. So to equity share capital. Against that, liability worth 3 lakh 50,000 is reversed. However, the liability is only 3 lakh 50 and we are issuing consideration worth 425 plus 15, that is 440. And hence, that company is giving me shares of Zia. So I will get investment in Zia. So equity shares in Zia, 9,000 shares of rupees 10, that is 90,000. So if I look at like a barter transaction where the liability is foregone, 6% debentures account debit, 3 lakh 50. Investment is received. Investment in equity shares of Zia, 90,000. 2, you are giving up Chennai Works, 425, and to equity share capital worth 15,000. Are we clear with this? Okay. So this is done. Important adjustment. Next, the Chennai Works compensation fund disclose that there were actual liabilities of 1,000 only. Okay, so what is a compensation fund in Chennai Works? Now, Bombay Works is still with you, but Chennai Works you have given up. So maybe their workmen's compensation liability is also no longer there. So if you look at Chennai Works liability, assuming you will pay that off, So this is 5,000 and you're probably going to pay off 1,000, that is actual liability, which means the remaining 4,000 will be transferred to the capital reduction. So you'll say Workmen's Compensation Fund of Chennai Works account debit, let's say 5,000, to bank, let us say 1,000, to let us say capital reduction 4,000. If that is not yet paid, then only liability of 1,000 will remain and the remaining 4,000 will still be transferred to the capital reduction account. As a consequence, investment of these funds were realized to the extent of the balance. Why to the extent of the balance? Because 1,000 will be used to pay off, and hence out of the 15,000, I will say minus 1,000 which is used to pay off that bank account debit to investment. So basically I can say Chennai Works Compensation Fund account debit 5,000 to investment of 1,000 that you will pay off, to capital reduction 4,000. The remaining investment is 14,000. Okay. And I'm selling that investment of 14,000. Entire investment was sold at a profit of 10% of book value. So 14,000 plus 10%, that is equal to 15,400. And the proceeds were utilized for part payment of creditors. So what is happening, sir? In this case, first of all, your liability, Chennai Workmen's Compensation Fund account debit 5,000 to investment 1,000. Maybe you're using the investment to pay it off to capital reduction, or it may also happen that you're transferring that investment along with the liability to Zia, who is taking this over. So the actual liability was 1,000. So along with Chennai Works, you have transferred the liability, and 1,000 worth of investment also you have transferred, or you have paid it off. The remaining 4,000 is no longer a liability, can be transferred to capital reduction. So the balance investment that are remaining is actually 14,000. 15 minus 1, that is 14,000, and that is sold at a 10% profit. So bank account debit 15,400 to investment 14,000 to capital reduction 1,400. Okay, and this money that you have got 15,400 is used to pay off trade payables. Trade payables account debit to bank 15,400. So these two, I guess, are the important adjustments over here. And if you do this, other than that, the question loses its sting. There's nothing else. Inventory was to be written off by 1,90,000. So capital reduction account debit to inventory. Provision for doubtful debts 20,000. So to provision for doubtful debts or debtors 20,000. Chennai Works is completely written off. Earlier it was 775, 350 written off, 425 transferred. Nothing remaining. And any balance of cap reduction is to be applied as 2/3 to write off value of Bombay Works and 1/3 to capital reserve. So whatever is the balancing figure, let's say 300, 100 will be in the capital reserve and 200 will be to Bombay Works. And that's it. Pass the necessary journal entries. So if you go to see over here, all said and done. So you have written off inventory, provision for bad debts, and your regular P&L, even if it is not told, 4,10,000 will go. And the balancing figure over here is 4,01,400, out of which 2/3 will be towards Bombay Works and 1/3 towards capital reserve. Like in partnership, you split the profits 2/3, 1/3. In a similar way, you're doing it over here. So this is question 12A. Over here, this is 12B. It's a separate question altogether. It is similar to a July 21 exam question, which is there in your homework section as well. So the following scheme of reconstruction has been approved for Win Limited. It is also there in your study material practice questions. This same question, which came in the July 21 exams as well. The following scheme of reconstruction has been approved for Win, the shareholders to receive in lieu of their present holding of 1 lakh shares of rupees 10 each the following. So currently 1 lakh shares of rupees 10 each. So equity share capital account debit 10 lakhs. New fully paid shares 10 shares equal to 3/5 of the holding. So this is 1 lakh into 3 by 5, that is around 60,000 into I think 10, that is 6 lakhs. Equity share capital account debit 10 lakhs to equity share capital, new equity shares 6 lakhs. 10% preference shares being fully paid to the extent of 1/5. This is very important, of the above new equity shares. This is 1/5 of the above new equity shares. How many new equity shares are you issuing? 6 lakhs into 1/5 divided by 5. This is 1,20,000. Don't make the mistake of saying of what? We have clearly been told this is 1/5 of the above new equity shares, which means if there are 6 lakh worth of new equity shares, 1/5 of that is 1,20,000 will be additional preference shares issued. So to preference share capital 1,20,000 and 40,000 in the form of 8% debentures. To 8% debentures 40,000. So basically 6 lakh plus 1,20,000 plus 40,000, that is equal to 7,60,000, and hence the remaining, I believe 2,40,000 will be going to the capital reduction. So this is kind of an important adjustment. Equity share capital account debit 10 lakhs to equity share capital 6 lakhs to 10% preference share capital 1,20,000, debentures 40,000, and balancing figure capital reduction. The moment that is done, there's nothing else in my opinion in this question beyond this one adjustment. An issue of 1 lakh 10% first debentures was made and allotted. Payment for the same being received in cash. Bank account debit to 10% debentures 1 lakh. Khatam ho gaya. And next, goodwill which stood at 1 lakh 40 is to be written off. Capital reduction account debit to goodwill. Plant and machinery which stood at 2 lakhs to be written down to 1 lakh 50. To plant 50,000. Freehold property at 1 lakh 50 was written down by 50,000. To freehold property 50,000. So basically 1 lakh 40 and 50 and 50, that is 2 lakh 40 will go to the capital reduction account. That's it. What are we supposed to do? You're required to drop the necessary journal entries in the books of Win for the above reconstruction, and narration should form a part of your answer. Perfect. Next you go to question number 13. Parth Limited had laid down the following terms. Again, this is a study mat question. Following terms for sanction of reconstruction plan by the court. Furniture and fixtures which stood in the books at 1 lakh 50 to be written down to 95,000. So this will be capital reduction account debit to, for example, furniture. How much is that? 55,000. The freehold premises which were valued at 7 lakhs showed an appreciation of 55,000. So this is freehold premises account debit to capital reduction 55,000. Plant and machinery showed a fall in value of 89,000 to be recorded in the books. So this is to plant and machinery. This will be a fall of 89,000. Investment at 2 lakhs was brought to the existing market value of 1 lakh 5,000. So basically over here, even investment will be created. To investment. How much is that? Sir, 95,000. 2 lakhs है 1 lakh 5. Okay, this is the interesting adjustment. Debentures accepted to receive the following in lieu of their present 9% debentures of 2 lakh 50. So this will be 9% debentures account debit 2 lakh 50 to 1/5 of the total to be paid in cash. So this is to bank 1/5. I think this is 50. To take over the land and building of the value 72,000. So this is to land and building 72,000. And to forego the remaining as a policy of reconstruction. So this is 250 minus. So I think 128 will go to the capital reduction account. Write off the P&L debit balance of 70,000. So you will also write off 70,000 that has been accumulated over the years. In case of any shortfall, the balance of the general reserve of 1 lakh 50 will be utilized to write off the losses under the reconstruction scheme. So over here it is possible that your balancing figure might come on the other, that is credit side. So buy something. So we said then you will use buy general reserve. Show the necessary journal entries as a part of reconstruction process, considering the balance in general reserve is utilized to write off the losses as per the reconstruction scheme. So over here, if you go to see the first few entries in question number 13, the same, you write off everything, plant, furniture, investments, even P&L debit balance. Then freehold property value is appreciating. Then you look at debentures settled by cash, land and balance, and then general reserve account debit to cap reduction. You can prepare a cap reduction account. The balancing figure is 1,26,000, which will be adjusted through general reserve. Okay. Next you have question number 14. Again, this is a practice question. I believe there is nothing significantly new over here. 15 we have already discussed. So this over here, Recover Limited decided to reorganize its capital structure owing to accumulated losses and adverse market condition. The balance sheet of the company as on 31st March is as follows. So you have been given the balance sheet, and then subsequent to approval by the court of a scheme of reduction of capital, the following steps were taken. First, preference shares were reduced to 2.5 and equity shares to ₹1. Same Gisa beta adjustment, preference share capital account debit over here 1 lakh 50 to I think these are 15,000 shares of ₹10. This will be 15,000 into 2.5, 37,500, and hence the remaining 1,12,500 will be taken. So this is 1,12,500 in the capital reserve. Same is the case with equity shares. ₹1. So this will directly fall. 2 lakhs debit to share capital 20,000 and remaining 1,80,000 in the capital reduction account. Okay, next you have one new equity share of ₹1 was issued for arrears of preference dividend for past 4 years. So one new equity share of ₹1. How much is the arrears of preference dividend? It is just disclosed. Preference dividend have been in arrears for 4 years. This is 1,50,000 into 8% into 4. I think 48,000. So the entry will be capital reduction account debit to share capital 48,000. Perfect. Next, what do you have? Over here, the balance on securities premium was utilized and transferred to the capital reduction account. So this is securities premium account debit to capital reduction. This is 10,000. The debenture holders took over the freehold property at an agreed figure of 75,000. What is a freehold property? 1 lakh 20. They're taking it over at 75,000 and hence there is a write-off for 45,000. Capital reduction account debit to freehold property 45,000. Capital reduction account debit to freehold property. Where is this? Yes, 45,000. Security premium is also taken. And then you are settling and paid the balance to the company after deducting the amount due to them. Acha, how much was the amount due to them? If you go to see, for the debentures, you have 55,000 and within 55,000, you have 50 and 5. So total 55,000 was due to them, but they are getting property worth 75. So 20,000 they are going to pay back. So the company, they will pay, so company will receive. Your entry will be debentures account debit 50, accrued interest account debit 5, bank account debit 20 to freehold property 75. So over here 55, 20 you receive in bank and to freehold property 75. Plant and machinery were written down to 1 lakh. Non-trade investments were sold for 32. Same gisapita adjustment hoega. Plant and machinery is written down, whatever is the balance, down to 1 lakh. Trade investments are sold. So if I go to see in trade investments, you had 40,000 sold for 32,000. So there's a 8,000 loss in the capital reduction. Plant and machinery, if I go to see in the notes, plant and machinery is I think 1 lakh 30. So there is 30,000 reduction. Goodwill and obsolete stock of 10,000 were written off. So the entire goodwill, I believe, of 50,000 and 10,000 worth of obsolete stock. So your journal entry will be capital reduction account debit to plant 30, to goodwill the entire 50, to inventory 10,000 and P&L debit balance whatever it is. Okay, next what do you have? This is interesting. A contingent liability for which no provision had been made was settled at 7,000 and the amount of 6,300 was recovered from insurance. Usually we have seen questions where you are settling it, but यहाँ पे insurance भी आ रहा है. So your entry will be capital reduction account debit 7,000 to bank 7,000, but then bank account debit 6,300 to capital reduction 6,300. Basically net effect is 700 going out of your pocket, so you can pass the net entry of capital reduction account debit 700 to bank 700, and that's about it. You're required to pass the journal entries and prepare the balance sheet, and that's about it. So you'll prepare this balance sheet and 30,800 will go to the capital reduction account. So 15 we have said it is similar to question number 6. 16 we have discussed. The other homework questions are broadly more practice questions only on similar lines. As you can see, it's a fairly scoring chapter. I'll request you to even review question number 8 from your homework section. There's nothing new except for 2 adjustments. So we'll just discuss that from your November 22 paper. So this is your standard balance sheet, your standard notes to accounts, and what you have is note number 1 which is slightly different. Note number 7 which is slightly different. Ajay, if I look at note number 1, this is an adjustment which is very common even in amalgamation questions. The preference shares are converted from 6% to 8%, but revalued in such a way that the total return remains unaffected. So what are your preference shares? Currently 6% preference shares of 6 lakhs. So what is your preference dividend? 6 lakhs into 6%. I believe this is 36,000. Now the new preference shares are 8%. Now if 36,000 is equal to 8%, your total preference shares are how much, sir? 4 lakh 50. Which means your journal entry will be preference share capital 6% preference share capital account debit 6 lakhs to 8% preference share capital 4 lakh 50 and to capital reduction 1 lakh 50. Other than that, you have standard entries like equity shares brought down to 8, arrears of preference dividend cancelled, so no entry, debit balance of goodwill is written off, land and building, plant and machinery are evaluated at 85 and 80%, standard entries. Book debts of 14,400 are treated as bad. So this is all adjustment for assets. Next is point 7. This is another interesting adjustment. The company expects to earn a profit at the rate of 90,000 per annum for the current year, which would be utilized entirely for reducing the debit balance of the profit and loss for 3 years. 90,000 per annum. It is expected to earn from the current year in each year, which will be utilized to reduce the debit balance in the P&L for the next 3 years. The remaining balance in the said account will be written off at the time of capital reduction. So usually in every other sum, what you used to do is you used to write off the entire balance in the P&L. However, here we are okay keeping some balance in the P&L because we know that 90 is going to be earned in the next 3 years. That is 2,70,000 will be earned in the next 3 years, which against which this P&L balance will be automatically nullified. So for the remaining, that is 3 lakhs minus 2,70,000, that is 30,000. Is your entry for capital reduction account debit to P&L. So over here, out of the 3 lakhs, I will say 2,70,000 of P&L I will not touch because it will be adjusted against future profits. For the excess as given 30,000, we will pass capital reduction account debit to P&L. That is the next adjustment. Other than that, the total balance of capital reduction is to be utilized in writing down patents. So the balancing figure will go to patents, and a secured loan of 4,80,000 is obtained by mortgaging fixed assets for repayment of bank OD. So basically, you will take loan, bank account debit to loan. This is a secured loan. You will mention that this is secured, and then bank OD account debit to bank, and that's about it. So in my opinion, I'm not discussing the entire question, but for these two adjustments, which are relatively fresh and which are relevant. So that kind of takes care of your internal reconstruction in a very, very compact and a bulleted form. I hope you have at least in a very limited time managed to get a hang of the entire chapter, and we'll continue soon with other chapters. Till then, goodbye, good luck, and keep studying. Take care.